Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the Market Site studio, we have Kevin Mahn. He's the chief investment officer at Hennion and Walsh, and he thinks that stocks could end up positive for 2022. And you know what, Kevin, it was so refreshing to actually say that statement. But before we get into that, Fed Day is finally here. We're going to get the rate announcement at 2 o'clock. Powell's going to have his presser immediately after.
Yes.
What are your thoughts going into it, and then what should they do for the balance of the year?
Great question. So I think in all likelihood there'll be a 75 basis point rate hike that he'll announce in about a half hour now. Then they don't meet again in October. They come back in November and December and going to face an economy that continues to decelerate and arguably still meets the definition of a technical recession. We think they become less hawkish in November and December. And that 75 basis point hike that they're about to announce should be the highest rate hike that they have for this particular rate hike cycle, recognizing this is the third consecutive 75 basis point hike. So if in fact we've now reached peak hawkishness, peak inflation, that should provide an uplift for stocks in the second half of the fourth quarter of this year.
Let's say the Fed does go too far with their policy, right? What do investors do? How do they manage their portfolios?
Great question. It's hard to trust the Fed right now, right? We're not so far removed from their transitory comments. We're not so far removed from May when they said they weren't considering any hikes above 50 basis points. And now are we to believe that they're going to pivot and turn less hawkish by the end of the year and perhaps just keep rates constant next year? My fear, to your point, is that they're going to continue to be too hawkish in the face of an economy that continues to slow. If they do, that could push us to a deeper and more protracted recession that would have otherwise occurred on its own. If that happens, you look to those traditional defensive sectors, healthcare, utilities, consumer staples. Those are good places for investors to position their money. Look for good dividend-paying companies with strong balance sheets that could weather those recessionary periods.
Kevin, do you think investors simply need to be patient? Just because we do rate hikes does not mean that everything corrects the next day. And we're so conditioned over the past 10, 15 years, everything's up and to the right, dips are being bought, and this policy is going to take, in my mind, 9, 12, 18 months to work itself through the system.
Absolutely. Investors need to be disciplined and avoid those knee-jerk reactions to the news headlines or today's announcement or November's or December's announcement. More so, they need to maintain their risk discipline in all market environments. You know, there's a stat that going back to 1990, had investors just missed out on the 10 best days, their returns would have been cut in half. Timing the market is an exercise in futility because you have to get it right twice. When to get out and when to get back in. It's when to get back in that often proves the most difficult.
Let's talk about the strong finish for stocks in the fourth quarter. You had mentioned before, okay, we know what the Fed is doing. We know that these hikes are coming. Why else do you think that they could end positive for the fourth quarter? Anything in the earnings picture you're looking at?
Another big event in November, midterm elections. And historically, stocks have risen on average about 16% in the 12 months following midterm elections, going all the way back to 1960. We also know that the stock market and the economy tends to perform best when we have a divided government. As it stands now, and of course the polls could change between now and November, but it does seem as though we're going to have a divided government after the midterm elections, and that type of gridlock could bode well for stocks and also the economy. So those two tailwinds, I think, could provide an upward lift to stocks in the fourth quarter this year, specifically those areas that have been beaten up the most thus far in 2022. Technology, consumer discretionary, e-commerce, those are the types of areas that should have the biggest rebound coming off of the biggest pullback thus far.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.